Hi guys, welcome to SavvyMoneyShow. Me, host Sean. The market's selling off ahead of CPI data. Looks like we've been rug pulled, but presents an opportunity. Don't think we're at the bottom yet, but there's nothing wrong with averaging down as long as you keep some cash on hand in case it goes lower. Of course, you don't have to hit the bottom. Just make sure you're protecting yourself so you don't get forced to sell. I wouldn't be going in margin. There is a campaign out to try and get MicroStrategy margin called if you're in crypto, which means Bitcoin has to hit below 21k, which will pull down the rest of crypto. So I'll try and clear your margin on any crypto or crypto related assets. Now, I am going to talk about earnings. Don't forget to hit the lovely like button and sexy subscribe button, and don't forget the bell notification. You'll be notified when a new video gets uploaded. And the free links in the description below. You can pick up a free share worth up to £200. And check out our Discord. And if you want a more in-depth analysis of any stock or market conditions, then why not look at our upgraded membership program and support us. We start with Tattoo Chef. Now, there was a sell-off. You had people who was just looking at numbers from Twitter, and I don't blame them because they're not invested in the company. They're just reporting it. So they don't know enough about the business, who are slagging it off and saying, why would you be invested in it? Now, they beat earnings. The stock went up and is now down, but they have, their margins have decreased to 10%, and they lowered guidance. And if you look at the reasons why, you have Zach's rank of sell for the stock. First of all, that will also cause people to sell, and you have the fact that their guidance, they didn't bring it down that much, but I'd rather they bring it down now when the market's bleeding than miss guidance next time round, or miss earnings next time round, or the end of the year when it's recovered or possibly recovered. The thing is, you have to look at the fact, although they've produced a loss, yes, they could have produced a profit if they hadn't made the acquisitions, but these acquisitions are key for them to build their brand and an ecosystem. At the moment, with the market, you are having people who are stockpiling labour, stockpiling people, workers, the way people were stockpiling goods when there was a goods shortage. So for them to have actually got a plant, all the machinery and the staff for such a small amount is good value. The thing that made me a bit worried about them previous earnings, a bit fidgety whether to keep or sell, was they wasn't running a business the way I would run a business. And I know their business is a lot bigger than my business is, but you've got to ask yourself, do you want a DraftKings or Uber, or do you want a Penn or Tesla? And the first ones are growth at any cost, at risk to the company. The second ones are growth while protecting the company. And you have to see that DraftKings has no path to profitability, whereas Penn does. You see with Uber, they keep saying 1 year away from profitability. Tesla already is, and look at the margins on that. They have brought in assets that will bring down their costs. They have prepared for going from 60 million to 600 million in revenue, but that means taking on more staff, taking on more executives, bringing it on refrigerated areas, which will all bring down costs in the long run, but in the short time it's going to hurt. You only have to look at Neo. Neo was thinking of building an ecosystem, doing all the manufacturing themselves, but because it would hurt them short term, they didn't. And I do think that was a mistake for Neo. So they continued outsourcing. I think Neo, if they're going, once they're through this period, should take that up again. Anyway, I think Tattoo Chef here looks very promising, but it is a long-term hold. Upstart now it's at $42, which is 10% of its all-time highs. Why? I mean, it beat earnings, but the only two bad points I saw was that its forecast being cut due to uncertainty of loan volume, rate hikes, and things that was already expected to have an impact. Now, and how they needed to use their cash in balance sheet for funding loans originated, mainly due to investors needing some time to calculate their new return hurdles, which causes a gap or delay in responding to funding. It's only temporary to keep the transactions for borrowers fluid. There's so many good bullish points announced in the conference call that seems to have been ignored. People are just happy to flush this down. But I think you already have investors worried because Zillow's AI didn't work, causing it to tank. You add in a dose of a suspected housing crash, a recession, and the Michigan report stating people will buy less cars over the next 5 years, and it's no wonder that guidance will be low. But all of last night's guidance was low. Palantir. Now, I never thought I'd see it at $7.50 again. If it comes down to 5, I will pick it up again. I sold it at 21, as you know. And it's one that you won't see return and for at least a year, and I think there are other growth stocks that you will see a return before then. You have to realise that it has a lot of cash and cash equivalents on it. It's a balance sheet. It's prepared for this event and a black swan event by buying all the gold at a cheap price. It could sell that gold now if it wants to. Things like the war, and so is prepared for these events. And now, so it is normally the kind of product that does well, but it is still the kind of thing that has a price of sales of 12.6, price to book of 9, and there's a lot better value products out there, and forward PE of 53, and that stock-based compensation argument isn't going away. And when you have Arrival at $1.50, then, well, I know Arrival doesn't have the growth or the same future or even the same industry as Palantir. You just have to wonder why. Why people went into this at 20. I do like it. I do like it long term. But there's also a lot of other stocks I like better. So once again, it goes on my watch list not to buy it at the moment. Who would have thought we would see Coinbase in the 80s? Yeah, especially with it building out an NFT marketplace. I know it hasn't had the same amount of visitors, but then I just think this is the kind of industry where NFTs have gone down recently. I'm not saying in value, I'm saying that visitors to over NFTs, you can see from the trends, it's not as big as it was. I'm not saying it won't become big again, but it just doesn't seem at the moment. Also, with crypto being down so much, and as I said, talk of trying to get MicroStrategy margin called, the risk of it going below 21k. I remember when it was 6k a coin. So, not that I think it'll get there again. There's too much attention on it. But this is a kind of stock, when crypto is up, it gets up. So it's commodity based. And I mentioned that when it was 180. So, and that's why I said during the IPO I wouldn't be going into it. I played it, I sold it for a short profit, and now I'm not in unless crypto bombs. Disney. Personally, I think Disney Plus is a $200 stock on its own. I think Disney Plus is just a cherry on top, and people are concentrating too much on Disney Plus streaming numbers, trying to compare it to Netflix, when the parks are the real money driver, and it used to be the cruise lines that were the cherry on top. The parks are jam-packed, and they're spending money on new rides as well. And look at this market cap, 205 billion versus enterprise value 244 billion. Forward PE of 25. And it's just great value right now. It's the cheapest it was at pandemic levels was at $90 a share, if I recall. It's at 106 now. And I had its issues, like PR-wise, politically, and I know it has to start paying taxes unless it abides by certain guidelines. But the thing is that may affect it. It's not going to affect it like massively. That's what accountants are for. No. Not saying that's wrong or right or wrong, but you know, look at how much tax the likes of Apple and Amazon pay, and then tell me that Disney being forced to pay tax all of a sudden after they haven't for so long is worth them getting such a haircut. Or their PR issues recently is worth them getting such a haircut. IONQ, $5 a share. Now, when you think it was $30 a share, it's unbelievable. This is #1 quantum computing company in the world. It's on both Microsoft and Amazon platforms. The only reason Google sold their position was to try and beef up their earnings. I still believe their idea was to buy it back after earnings if they beat and didn't go down. Hyundai and IONQ expand their partnership. You know, it had a short report come out, which was laughable. It's named one of Time's most influential companies. And the thing is, do you really think these companies, such as Microsoft, SoftBank, Hyundai, Amazon, you know, NVIDIA, all these companies who work, and there's a long list of them who work with IONQ, are going to not do their due diligence? And the short report said our opinion, and may not be true at the bottom of it. I mean, this is a growth stock, so beware that. I know the price to sales is huge. The price to book is not. And remember, they have a military contract as well. Do you not think they would do their own due diligence? The thing with IONQ is I believe it will power everything in the future. And my only worry is if it gets bought up before then. Now, I hope not, because I hope I have time to buy up more. If you found any of my videos helpful and you want to help me make more, you can support me by buying me a coffee. The link is in the description below.